I like this scenario. Imagine if you go on to Amazon and you shop for a product and then you hit click to buy it, and a, a screen pops up and says, "Thank you for shopping Amazon." One of our representatives will get back to you within 7 days and tell you if you are eligible to buy our product and how much it will be.
Yeah.
Have a nice day. And
That's great.
And yeah, I mean, that seems antiquated, and yet you and I both realize that's pretty much the experience in insurance right now.
Yeah.
For most lines of business.
I'm Jim Albert, and this is the future of insurance.
This episode is brought to you by Medallia, the market leader in customer and employee experience. Their award-winning SaaS platform, Medallia Experience Cloud, makes all your other applications customer and employee aware. Medallia uses proprietary AI and machine learning to reveal predictive insights that drive powerful business actions and outcomes. Leading insurers like Prudential and Zurich use Medallia to reduce churn, turn detractors into promoters, create in-the-moment cross-sell and upsell opportunities, and drive revenue-impacting business decisions. Learn more at medallia.com. And the Future of Insurance book series, available exclusively from Amazon or at future-of-insurance.com.
Jim Albert, thank you for joining me for the show. And for the book. Because that was I feel like I've been asking so much of you lately, but it's great to get you on here.
Hey, it's a thrill to be on, and I really appreciate you having me, and happy opening day of the 2021 baseball season.
Oh, that's right. Yeah, we're recording just as things are getting started. The Red Sox have postponed their game, I hear. So we still have
Already
some time in Boston. Yeah, it's raining here.
Well, I grew up in New Jersey, so just to have fun at the start of our podcast, we'll get to predictions at the end, but one of my predictions is the Yankees will win the World Series this year, Brian.
I don't think that's a tough prediction to make. I can predict the Red Sox certainly won't, but we'll see. It's kind of a new team this year. All right, let's get off this topic really fast before we each have to take angry sides against each other. So Jim, you started a company called Neptune Flood. I'd love to hear a little bit about that journey, creating this, and kind of what was the mission in doing this, your background, some of the major milestones, some of the ins and outs or pitfalls and things that you guys survived and learned from, kind of a nutshell version of what we get into in the book.
Yeah. It's fun to have a conversation like this because it's 2021. I founded Neptune in 2016. So we're in our sixth year, or 5 years, full years into this. And it's just remarkable that I'd never done a startup before. So they say it's a good thing I didn't know what I didn't know. Otherwise I would have never done it. But in 2015, I left an insurance company that I've been working for, and about the same time teamed up with Bill Martin, who's the co-founder of Neptune, with me. And he and I
started. Guy though, you weren't.
I was
on the insurance side. You were.
Yeah, I was all tech my whole career. So I worked in AT&T Bell Labs, and then I worked in IT consulting, and I had been involved in some of the early web work for companies like Sony and Microsoft and HP, and early e-commerce stuff when companies were first displaying their products online and then selling their products online. Yeah. And seeing how transformational that was to a user experience backed by data analytics and business intelligence. And then I got in the insurance space and said, wow, I feel like I've gone 20 years in history in one fell swoop. After the 3 years with the insurance company, then Bill and I started Neptune. And the idea was make it easy to buy flood insurance. I'd seen it in other lines of business. Bill is a big data guy and just a brilliant insurance person. And so I brought a technology angle and from other industries, and he brought the insurance street credibility as well as the data analytics piece. And we put it together, and in 2016 is where we really evolved it into a flood business. And I came up with the name of Neptune Flood, which was a fun side story in itself. But making it easy to buy flood insurance, the issue in flood insurance for anybody listening to your podcast that doesn't know is that it's actually a relatively small space. There are only about 5.5 million residential policies in the US for flood insurance, but there are 60 million homes at risk of flooding. So, so you can run the numbers. It's like 90% of the people who are at risk don't have any insurance at all. And that's just a big problem. So started the company feeling like, okay, I've got a chance to do something really good here that applies some expertise that I've got from the past, and teamed up with a brilliant person to go do it. And so we rolled the dice and went ahead and started it up in 2016.
And it obviously, like, I know listeners are heavy in insurance, so they probably know this, but maybe not, or maybe there's some non-insurance folks listening in. But I think a lot of homeowners just presume that they're going to have flood coverage built into their homeowner's policy. And it's only if you're in like a floodplain that you need some extra coverage. So they think if they have water coming in from the outside and not, burst pipe or something, oh, that's, I'll call my homeowner's insurer, I'll be taken care of. That's not the case. My house flooded because the water table in our town rose, and we're not in a floodplain at all. And there's no coverage whatsoever. So I think it's these, the sooner or later you break down and you get AAA. Multiply that out beyond the cost of a new tire. We're talking tens of thousands of dollars or more in some very devastating situations. It's a real problem.
Yeah, the average loss in Hurricane Harvey was $117,000.
Yeah.
80% of the people who had losses in Harvey had no insurance at all.
Yeah.
So think about that. The federal government is not going to come in and bail you out. A lot of people think that, okay, great, FEMA swoops in and I'm all good. They're going to cut me a check and I'll be fine. Well, the average FEMA check was $4,000 after Harvey.
Against that 117 or what? Yeah.
Yeah. And that's not a criticism of FEMA. Their goal is to get people back on their feet, not recover all the losses. And the same thing happened in Hurricane Florence. Same thing happened in the Midwest floods of 2019. So this just happens again and again and again. And there's a lot that needs to be done here, Bryan, and maybe we'll hit this in predictions later on. But the trajectory needs to accelerate to get more people covered for insurance and help people understand, like you said, that their homeowner's policy does not cover flooding. And their risk, even though they're in Iowa or Nebraska or Arizona or Michigan, a lot of these states that are not on a coast have significant flooding events every year.
Or I live on a hill, so I'm okay. I'm uphill and my house flooded, which I didn't even think would be possible. But I guess there's still hill behind me, so it had to come somewhere on its way downhill, didn't it?
Yeah. So what did it do? Did it wash out, washing down the hill and fill up your basement? Or
yeah, so I came down one morning and the carpet was all wavy and shiny.
Oh
and
no!
I just thought my eyes were blurry, and so I stepped down and my foot went underwater and the carpet sank. And that's when I was like, something's very, it had been raining hard for days. I put our cars out in the driveway because I was like, oh, free car wash. I just saved $18. Unfortunately, basement flooding cost a little bit more than that. The water remediation, destruction, the demo work, ripping up everything. We had a finished basement, and it was tough. I mean, luckily it was just our basement, and we caught it the day that it happened and everything. But yeah, it could have been so much worse, but it was bad enough.
Yeah. Well, you look at the last 4 years. When I started Neptune in 2016, there'd been a run of about 9 years of really low hurricane activity, and the loss ratios were probably great for anybody that had written flood for those 9 years. And of course, my first policy year is very late 2017, and then 18, 19, 20.
Record storm years.
2017 was Hurricane Harvey, and 2018 was Irma and Maria, and lots of them, and then Midwest floods in 2019. And it's been 4 years of flood carnage as climate change is happening.
Yeah.
Which in the end really helped us cut our teeth and prove in our underwriting model, and that it actually is exceptionally good to use data analytics. It helps you deliver lower loss ratios as well as transform the user experience.
Yeah. So I cut you off to go into the the misunderstanding and the presumption on the part of homeowners that like, oh well, the government or my insurer, someone's gonna step in, so I don't need to buy coverage. My bank didn't require it, so what do I need to get this for?
Yeah, yeah. And I guess the other thing in starting the company was that the dominant carrier, so to speak, was actually the federal government.
Yeah.
So when Bill and I were trying to decide what space do we fill in here? Do we go into flood, or do we go into wildfire, or homeowners, or commercial, or what? The opportunity in flood looked too good to pass up. One is because we could do good and help people fill that coverage gap. But the second is that the 90% provider is the federal government, and it actually does take an act of Congress to change their program. Yeah. So they were very, very slow to move just by design. There's some really committed people there that really know their stuff, but just structurally, it couldn't move fast enough to meet the needs of the market. So we were able to go in there, and we created. It's real simple. By making it easy to buy flood insurance, we created a 2-minute quote to bind process. And I've been saying 2 minutes ever since we founded the company, but it's really about 45 seconds or quicker. You've done a quote. You've seen our platform.
Yeah, it's crazy.
And
the
that
comparison point is not 2 minutes. It's like 2 weeks, really.
It's like 2 weeks. Yeah. It's 54 questions and an inspection of your house that costs $400 and a 30-day wait and limited coverages that usually, especially in Massachusetts where you are, probably doesn't cover the full cost of the home. So you're actually underinsured. So there are lots of ways to improve it and provide optional coverages that people really need, like replacement cost.
Yeah.
And temporary living expense. If you get moved out of your house, those hotels are really expensive.
Yeah.
So things like that, we just added to the product, and then using digital technology, using data analytics, and using good web design, put out a product there that now you enter your address, and within 3 questions, you've got a quote. You can sign your policy electronically. You can pay for it electronically, and you're done.
Yeah,
you've got it.
3 questions seems to be the magic number. You know, writing this book and all these startups and talking to lots of them, everyone's gunning for that 3 questions. Sort of like name, address, and then some other key question about the rateable at issue, and you're done. When you said the existing process is 54 questions, there's some lines that are literally hundreds, and carriers are proud when they get it down by 100. But 3 questions is not. I mean, that's like e-commerce. Retail is 2 or 3. When you think about address and credit card and product, there's 3 questions.
Well, so people have asked me, well, Jim, because you made it so easy, you must have cut so many corners that you compromised on data quality and underwriting results. Yeah. And actually, no. In fact, we improved the underwriting quality and improved the data quality because we already know the answer to the question, so we don't have to ask them. Yeah. And that was the fun design exercise of taking the NFIP's 54 questions, saying, okay, do we have this information already? Yes, we do. Do we know the year built of the house? Yes. Do we know the square footage of the house? Yes. Do we know exactly where the house is? Yes. Do we have a geocode that proves it? Do we have rooftop? All that kind of stuff we already knew, so we didn't have to ask it. So you just take that right off.
Doesn't know accurately, as accurate as the actual data that you have access to.
Especially square footage of the house. Yeah. Just ask anyone. I would have a guess on what this house is, and probably if I was within 20%, it would be remarkable.
I was 800 square feet off on the size of my house, and my house is not that big that 800 square feet was immaterial. It was a considerable difference. I'm dyslexic, and I just always had the numbers reversed. Lo and behold.
Yeah.
So you don't have to ask. You sought data from other sources.
Its use of third-party data is one of the big changes that's occurred in the industry. Think about it. Let's take a large carrier, Allstate, Nationwide, State Farm. They have a treasure trove of data about all their policies.
Yeah.
But actually, there are a lot of things they don't know. And so if they were to do a combination of call outs to APIs pulling in data from third parties, they'd have this really powerful data set for each policy. And they may do this. They probably do. In our case, we call out to 150 different data sources the second that address is entered. And then magic happens. So we assess the risk, and we've actually patented this technology. We put a price on it from our rating table. We evaluate the aggregation in real time. So most carriers do that in arrears. They look back 3 months, or they look back a year. We do it right then and there in that 1 second real time. And then we assign it to a bucket of capacity, to a Lloyd's capacity provider, or to Swiss Re, or to just one of the large global reinsurers. So all that happens in 1 second. We didn't send it off to an underwriting room. In fact, Brian, we don't have an underwriter.
Yeah.
The underwriter is a computer. So
was that an issue for Lloyd's? Because I've heard that come up where they needed an underwriter to be assigned to it. How did you deal with that?
Yeah, that was probably one of the first challenges challenges to the whole business model, because the model was that there will be no human underwriters and regardless of the years of experience, when you introduce human judgment, you introduce opportunity for error.
Yeah.
And so we believe that we could take all those underwriting factors and those underwriting decisions and put them into code so that they are reliably and accurately applied in every single case, and instantaneously as well.
Yeah.
So in late 2016, I went over to London and sat down with some of the Lloyd's syndicates, and I still felt really new to insurance. I was only 4 years in the industry, so it was a little uncomfortable. But the discussion was about digital insurance, and there was a huge amount of skepticism of, well, wait a second, for 300 years we've done it this way, and now you're suggesting a different way. But there were 2 or 3 syndicates that said, you know what, there may be something to this digital insurance model. And so one of them, they formed a team, and they backed us for our initial program and got us off the ground in 2017.
That's great.
Yeah.
And regulators as well, that's the other side, where they're expecting a licensed underwriter. So how do you face that? Because regulation was another one of the kind of surprise things as we talked through your story that you pulled forward in your business plan and really brought in as like a strategic advantage in what you were doing. Whereas I think a lot of people think is like, oh, compliance and regulatory compliance is that thing we need to be weary of and work around and kind of adversarial. You took a very different thought process around compliance. The NAIC, National Association of Insurance Commissioners, is, I think, doing an outstanding job of educating their members and having digital insurance and insurtech and surplus lines on the program for their meetings. And they meet quarterly now, virtually, but they meet quarterly every year, and it's really well attended, and their program and content is excellent. And you can see that with some of the uptake of the black box raters. So black box rater being, it doesn't expose all the rating rules like an admitted program. It just says, for these inputs, we will deliver an output that is a price and a decision on whether we'll underwrite that risk or not. And a number of states have now approved black box raters, and I think more and more that's an accepted approach, because they see how beneficial it is to consumers. You get an instant rate, it's really easy to use, it expands insurability, it expands coverages, it actually applies a price that's specific to that risk right there, that house. Yeah. It's not a neighborhood price, it is that house. And so I think it's very beneficial. But the regulators, I think, are coming along on this stuff. The one area that I think there still could be a lot of progress is there's a significant distinction between their policies for admitted carriers versus surplus lines carriers.
And so much of the innovation is occurring in surplus lines, and the change occurs. We're on version 125 or something like that of our risk selection and rating engine.
Yeah.
Well, in the admitted markets, you couldn't possibly do that. And therefore, if we were in the admitted market, our rates would be worse. There would be less people with insurance and less options to consumers.
Yeah.
So,
is that just an early days kind of thing for you, or is it like, do you expect that your model and your rating will continue to evolve that rapidly, or will it settle out at some point?
I would expect it to continue to change, because most of those changes have been enhancements to the underwriting rules, not price changes. There have been a few price changes along the way. Generally, prices go lower. The NFIP effective today went up 10.2%, and Neptune went up 0. So there was no price change, and the difference between NFIP just gets and Neptune gets bigger with anyone quoted today or later. But there's so much more data and so many neat analytics coming out that I spent a large amount of my time just talking to companies that are doing innovative things with data and technology. Satellite data. There's a company that's 7 satellites up called INSEAD that will have 17 by the end of this year. And they're constantly getting data about water depth and changes in condition and their weather analytics. There's flood modeling. There's structural and location data changes. And it's an explosion of change in the data and analytics availability. So yeah, we'll continue to refine our model and make it better and better.
Yeah. So I was wondering, because I know cyber is a space that, you know, was ENS forever, and that needed to be, because every week it seemed like the prices were changing and the coverage and everything, but it started to settle out. And so now you still have ENS, but you also have admitted offerings that are still competitive. But it feels like this is one where we still have so much more innovation to go, whether it's solutions like ISI, which has been getting a lot of attention lately, especially, and the analytics tools and the marriage of all that, because there's machine learning at play, things will continue to change pretty rapidly. I agree with you. I think there's still quite a bit of evolution before we can even contemplate being in a space that's more kind of steady state, like admitted.
Well, so look at it this way, that I like this scenario. Imagine if you go on to Amazon and you shop for a product, and then you hit click to buy it, and a screen pops up and says, "Thank you for shopping Amazon." One of our representatives will get back to you within 7 days and tell you if you are eligible to buy our product and how much it will be.
Yeah.
Have a nice day. And
that's great.
And yeah, I mean, that seems antiquated, and yet you and I both realize that's pretty much the experience in insurance right now.
Yeah.
For most lines of business. Think of buying commercial. We've tried to buy, I mean, we have E&O and D&O and general liability and all that kind of stuff, but it's painful to buy. So this ease of use, the fact that that's still the predominant model, that painful example I just gave, shows how far we still have to go as an industry. And much of that innovation is occurring in E&S right now.
Yeah. Oh, that's a good point. I was going to say with the admitted, non-admitted, and sort of like a fixed product versus one that continues to evolve, it's not only will we get back to you in 7 days and tell you if you're eligible and what you're going to pay, but by the way, it's the product from 2 years ago. It's not the current one that you were trying to buy, because that's not available to buy.
Right.
Anyways, we can keep going with that analogy, but it makes no sense when you really stop and put it like that. And we wouldn't stand for that in like any other place in our life.
Yeah.
So yeah, fair point. Lots of room to move. You know, distribution is something that's come up a lot for in the startup space, especially. And you guys have a number of ways that you try to get the product out. You did the direct thing, but then you also have kind of affinity or partnership, you know, through the mortgage brokers and the realtors, but then you also have some agents or brokers you work with, and you also work with other carriers. Is that right?
That's right. Yeah. So So if you were to distill our distribution strategy down to one word, it would be, or a few words, all of the above.
Yes.
and 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 that also was a tweak to the initial plan. The initial plan was to really choose a large agency in each state and say, have a field day with it. But no one agency can touch all the possible buyers in a market. So we quickly learned that we needed to expand our distribution to as many agencies as we could sign up that met our E&O and kind of quality criteria.
Sure.
So that was the first one, and we're up to 12 or 13,000 agencies across the U.S. and still a long ways to go. And you're right, we offered a direct-to-consumer option in 2018. I think we launched that, and that's still only 3% of our market. But what happens there is you get a lot of shoppers that come in and want to know how much flood insurance may cost for their house or for their business now, because we've just put our
you just launched commercial.
Yeah, we just launched our commercial direct to business as well. But you get shoppers there, and then if the shoppers need more information or want to talk to an agent, then we hand that off to our agents, so they get a hot lead coming out of it. But then you're right, Brian, working through mortgage brokers, working through realtor.com. If you check out the flood risk on realtor.com, which is a recent thing they put in just a few months ago, and then you click to buy a policy, you're actually getting, usually, I think, or perhaps exclusively, a Neptune quote. And then there's some other channels. I mean, eventually, you think about buying an airline ticket, and at the end it says, well, click here to opt out of the insurance.
Yeah.
So they're really forcing you to make an insurance decision before you can actually buy your airline ticket.
Yeah.
Well, there are a lot of places in Home Depot, what you mentioned when we were talking earlier, there's just a lot of opportunities for an insurance decision to come into play that'll help expand the market. And that's what we're trying to do. We're trying to touch all those places that people would be thinking about buying insurance. Because if you're in a mode of thinking about buying insurance, I want to be there at that very moment, because it's not very often anyone thinks, could I buy insurance today? I can't wait.
This is such a strong theme, especially lately, this notion of embedding the insurance purchase into the purchase of the thing you care about, or the asset that's leading to the need for insurance in the first place. Why are we separating that out into two separate transactions? Why not do that when the person's engaging in the thing that they actually care about right then and there? Like the plane ticket travel insurance thing, although I find that super annoying, because you have to make it like it doesn't pre-fill to no, you can't move ahead without it. And I always forget to click no or yes, whatever. But buying a car, buying a home, there's things that triggers. Why aren't we pulling that in?
Yeah.
So that's an interesting thing. And actually we talk about that in the book, because Clear Cover is one of the companies in there, and that's their business model is embedding. So the embedding theme is something we definitely get into.
Mm-hmm.
If that's something that's building in the industry, Jim, you mentioned predictions. What are some of the other things that you think are coming or starting to get some traction?
Well, so for me, one of the big ones is touchless insurance.
What do you mean?
I think it's another name for digital insurance, but touchless insurance is, look at what happened in 2020 with COVID, and it's still happening to us, really, in a large degree. We're still locked down and holed up in our houses. But one thing we really don't want to have happen is have an inspector come to our house. We don't really want to go to an office and fill out a bunch of paperwork for a policy. Nobody wants to do that.
Yeah.
Now, I don't have to do that to buy anything on Amazon, and I also don't want to do that for my insurance. But lo and behold, now a lot of these companies, such as Neptune, have come out with touchless insurance, where you enter your address and within a minute or so, you've actually bought your policy. You didn't need to sign any paper. You didn't need to hand over any money. You didn't need to have an inspector come to your house. So it's like we leaped from horse-drawn carriages to the Tesla electric vehicle all
Yeah.
in 1 year.
Yeah.
But the main point there is that it's not optional anymore now. Nobody's going to go back and say, oh, thank goodness we're on the other side of COVID. Now I want to go sign a bunch of paperwork and fill out a 54 question form.
Right.
It's not going to happen.
Wait for someone to show up at my house in some huge window of time that I have to take off from work.
Yeah.
Yeah.
So, but think of the implications of that. So if you're an incumbent insurer, a large insurer who had a multi-year plan to digitize your platform, then that just got blown up. You don't have multiple years to get there.
Yeah.
And that kind of leads to what I think is another evolution or prediction that I think we're at this inflection point. So I call it the class of 2015, 2016. So you've got Next Insurance, a really good company, Hippo with doing amazing and innovative things on both mitigation as well as insurance. Root's grown tremendously. Lemonade's grown. Neptune is a 2016 company. So those 5 companies, and there are others. It's not like these are the only ones, but those companies are getting a ton of traction and growing dramatically, getting lots of investment. I think Lemonade has over 1 million customers they recently announced. So what does this mean for the legacy or incumbent carriers? I don't think they can sit back and say, well, these guys are going to go away, or they can just turn on the gas and make the adjustments to be more competitive. I think that there's going to be an evolution where instead of big carriers and insurtechs, over here, I think that what's going to happen is that there will start to be this big collaboration, and we'll see partnerships. You'll probably see some acquisitions. You'll probably see ways of large carriers and insurtechs to team up and share their common expertise to evolve the insurance model.
Yeah. That was I was just having a conversation with Caribou Honig from ITC, and that was one of his. He went through his predictions from the original ITC to see how he did today.
Oh wow! Oh, that's a good conversation.
Yeah, really cool conversation.
Is that on your podcast? I want to watch that one.
Yeah.
Oh, good.
I still don't know which episode's coming out when, but yes, and I'll let you know.
Okay.
But it was I appreciated his honesty with the stuff he didn't get right, because he could have just skipped over those and been like, here are the things that I thought would happen, and look that they happened. But the partnership thing was a big one, and the collaboration, and that was one of his surprises in a positive way. He thought it would happen, but it's happening more than he even thought it would. And I think that's really interesting. And some of it's really explicit, that there's an announcement about it. But for others, it's kind of quiet. So you see some of the legacy carriers who are investors in some of the startups that on paper look like a competitor or a competitive threat, or, if it blooms into something, it could be. And so to see a traditional carrier taking that view that, well, we want to be a part of this. We want to have eyes on this. We want to see what's going on and have options with it. Rather than saying like, oh, it's a joke. They're never going to make it. I think that's really good to see. And it's not everyone, but there are definitely quite a few legacy carriers who are open to that and willing to be a part of or partner with some of these changes, which is great.
Yeah. And a lot of them, as you know, have their ventures groups, which are one way of them getting their investment toe in the water, but also just kind of monitor the evolution of the tech, and then almost like a proof of concept before they incorporate something into their platform. I think that the partnering makes a lot of sense for the large companies. Having spent a good part of my career in large companies, including a relatively large insurance company, that you have a legacy platform, you've got compliance issues you've got to deal with, regulatory changes, just maintenance. All these things have to happen. You can't ignore any of those things. So before you innovate and change and introduce all kinds of new stuff, you already have this debt to have to deal with. So trying to make a cultural change and say, okay, now we're going to innovate and create new products. Well, the faster way to market, I 100% believe for large incumbents, is to partner with an insurtech that has already innovated their way into the solution you're thinking about.
Yeah.
And most insurtechs would say, hey, if eventually you develop your own thing, great. But in the meantime, let's work together on creating value for each other and for consumers.
Yeah. It's gas on both of our flames.
Yeah.
It can be. Yeah. Jim, in the last couple of minutes, because I realize I've kept you here for a while. What are, if there's some advice you'd have for other startup founders, or maybe prospective ones? We were talking before recording about someone who's just starting something up that there's people listening, I think, who could take some wisdom from you, from the journey that you've been on. Because you're saying it's great to reflect on it now. I'm sure if we did this conversation in like 2017, you'd be like, I can't talk right now. It's too tense.
That's probably true. And I have no time because I'm working 24/7,
Right.
and I have to apply for an insurance license by midnight tonight. Yeah, it's a good question. And as I mentioned, it's my first, and I'm pretty confident will be my only startup. But the one thing, probably a couple things. One is focus and attention. A lot of people early on say, hey, I think you should try this. People wanted us to create our own agency so we could just get some cash flow going.
Yeah.
Or launch commercial at the same time we were launching residential. And that actually would have been a really bad idea.
It's so tempting, because
Yeah.
all the ideas sound great and necessary, but you can't do everything.
Yes.
Yeah.
Yep. So you've got to pick one and be really good at that, and constantly validate that it's a valid business model, but get really good at that. The second thing that we did early on was build for sustainability. In other words, become a profitable business.
Yeah.
So that as early as possible, we'd be able to have the test with our employees to say, hey, we're a profitable company, and you're going to be able to work here for a long time in up and down markets. It's okay. And as you know, that's if you put 100 insurtechs in a room and said, okay, all those remain standing who are profitable, you'd have a pretty small group.
Yeah.
So we went profitable in April of 2019. We remain that way now, and we're just we think that's, and we're still growing at a very fast rate.
Yeah,
but
that's right. You're not trading this off for like, well, we're growing 10% a year instead of 110%. You're still growing
Right.
tremendously fast. So it doesn't
Yeah.
have to be the trade-off people presume it to be.
I might have traded off, instead of growing at 500%, we grew at 250% or something like that. So there definitely is a trade-off, but I think it certainly helps me sleep at night. And then the third one, Brian, is, and this is really the biggest one, is choose your investors carefully.
Yeah.
Because eventually I was bootstrapping Neptune for a long time, much longer than I expected I would need to. And meeting with a lot of potential investors, and you get to the point of desperation where it's like, look, would anybody just cut me a check, please, now?
Yeah.
But I never went there, because I thought it was too important to get the right investor.
Yeah.
And you've heard horror stories of companies that went the wrong way on that.
Yeah.
And luckily, Bill Martin introduced me to Trevor Burgess in November of 2017, and in January 2018, Trevor concluded his investment, and it's the only investment we've taken. But what I was looking for was an active investor that would be a strategic partner in helping me grow the business, knowing that it is my first startup, and I could use a lot of knowledge on how to navigate the minefields out in front.
Yeah.
And fortunately, Trevor has done a lot of that with his experience at Morgan Stanley, and then starting and building a regional bank. So that was probably the most important decision I made, was, and for a startup founder to recognize that you are choosing your investor as much as your investor is choosing you, and you really need to be careful about that.
Yeah, you don't have to come from a place of desperation.
Yeah.
And that's, so of the, there's three major takeaways in the book. The capital one, both the investor and the capacity side, because the same thing can be said for the backing capacity that you have and whether there's really an alignment there or not, because that can also ruin you. And it's like, well, we have to get capacity or we can't exist. But if that capacity doesn't have the same strategy and alignment, like you said, if they want to go back and underwrite those risks in a traditional flood underwriting way, days and days with lots of questions, then your whole model is sunk.
Yeah.
No pun intended.
Yeah.
So yeah, I think that's 3 excellent points. And none of them is easy, because with each one comes that moment of pressure or anxiety, or, but that's a great idea. If we don't do that, will we, FOMO, like, do we give up the thing we should have invested in? We need to grow more and get in. Well, okay, but if your company doesn't exist, then that growth is like 0 times anything is still 0. And having the wrong capacity or capital, that can ruin you.
I was constantly asking people for advice. So in a way, that's great, because I got a lot of really good ideas on how to improve the business, but you're also getting a lot of
really good
ideas
the business
to take you off your focus.
Yeah.
So yeah.
Jim, so super valuable. It's always great to talk to you. But I love both the journey that you went on and the things that you learned and the way that you brought those into your own, the pivots and the changes. I think it's a really rich story. I love the advice for startups, but I do have to say, what you're doing, it brings me back to this sort of like, why do we exist as an industry kind of moments that, flood is an extremely real problem for a lot of people. And it can ruin not just, that year for you, but that can be generational financial devastation. That doesn't have to be that way. So
yeah,
I appreciate which path you chose from a product standpoint, because it's one of these things that needs to exist. So kudos to you for that and for the success that you've had.
Yeah, thank you. I mean, you didn't ask what I'm most proud of, but that probably is it. The fact that we've been able to expand the market to people who have not had flood insurance before and really do good with technology.
Yeah.
So we have every reason to be proud of our industry, even though it gets slammed here and there. But I'm proud with what we've done with Neptune, and thanks for calling it out.
Yeah, I appreciate that. Well, great. Thank you so much for the time, Jim. And all the best to you guys. You continue to do well, and I hope to see more of that from you.
Well, good luck with the book. I'm thrilled to be a part of it, and go Yankees in 2021.
Oh, sorry, Jim, we're losing you. Zoom's cutting out. All right. On that note, thank you so much for the time.
Thanks, Bryan.
Thank you to Jim for joining for this episode, which was great. And Jim's really good at telling the Neptune story and its reason for being, and what they've gone through and how they're pushing ahead. But also, he went into so much more depth for the book itself. So I'm not just thanking him for coming on here and doing 30-40 minutes, which is great, but he gave so much more of himself in the interviews and the run-up to the book coming up. Even with everything else on his plate, like they were growing tremendously well, pushing into commercials. It's like lots on his plate, and still just very generously and selflessly gave himself for what I think is a great story. So if you haven't picked up The Future of Insurance Volume 2, The Startups, you should do that. The first case in the book is Neptune Flood, and you get even more detail, like how he incorporated the company in a coffee shop in Maine on vacation. It just goes to show how simple lots of things are. And then we have insurance, and certainly flood insurance, that was not simple, and how they're on a mission to change that. It's a great story of Neptune and honest ins and outs and ups and downs along their journey through these moments that Jim refers to as the "this is it" moments, where it's like, are we gonna make it or not? Or what are we gonna decide in this moment, and what's gonna come of that? So really honest, open sharing from Jim for the interview, but even more so for the book. So do check that out, and you can get that at Amazon in whatever format you want, wherever you are in the world that Amazon serves, which is a lot of places, but I know it's not everywhere. It's a lot. or you can go to future-of-insurance.com for more information, which is also where you can find out more about the podcast and get the show notes for this episode and others, and send your friends to so that they can learn more and check out the podcast as well. Thank you to Medallia for making the podcast possible through their sponsorship and support. And thank you to you for sticking around to the end to hear all that, and to remember to subscribe if you haven't yet. I hope these interviews are valuable to you. This is the kind of insight and thought challenging that we need to keep moving the industry forward. So thank you, everyone, and I look forward to bringing you another episode next time.